Engineering conglomerate L&T posted a stellar set of earnings. In conversation with us right now, we've got Mr. R Shankar Raman, the whole-time Director and CFO. Thanks so much for taking time out. The highest ever order inflow is what you have reported, a 72% year-on-year growth. There was clearly that capex tailwind that played out. Take us through the outlook, given that the guidance has been optimistic. You're confident to outperform. What's driving this confidence? What's the outlook on the domestic order book?
Good morning. I think the order book that we have reported, particularly the order flow that we have reported in quarter two, has been largely helped by significant orders in the Middle East. While for the 6-month period, the domestic orders have grown by about 15%, it's very significant that we are getting a lion's share of the international opportunities that we participate in. What this possibly demonstrates is the company's technical capability, the cost competitiveness, and above all, the client confidence that whenever there is a large capex program that gets announced, L&T is in the forefront of that opportunity. Of course, there are competitive pressures which enables us to win some, lose some, but significantly all the complex engineering jobs, I think L&T stands at the pole position. So this has been an endorsement of the years of engineering expertise that we have invested in as a company. And whenever there is an investment momentum of the kind that we are seeing now, that becomes a natural outcome of us to remain successful. We are conscious of the fact that investments are always cyclical. They're never linear. So to that extent, it is very important that we make the best out of the opportunities whenever investment momentum is in our favor. And that's what is happening. I think what India is investing, what Middle East is investing, we are right at the thick of all of those in terms of our competence and capabilities. And our track record over the 80 years most definitely helps. I think these have been the factors and that's helped us reach where we have.
When it comes to margins, the job mix and legacy projects, that impacted margins a little bit. But going forward, you said that the operating margins will improve from October to December. Tell us a little bit more about the completion of execution of new orders. When will that be carried out and what's the margin trajectory?
See, out of the $55 billion order book, about 450,000 crores, nearly 40-45% of those are jobs that we have picked up during the early 21 and the COVID years. So to that extent, I think those are what we call as legacy jobs, where the costs that we had quoted and the prices that we have been able to obtain from the market, thanks to the supply chain disruption and all the other ramification of COVID, was that the margins have got squeezed. So what we are washing through our profit and loss account over the last 6 quarters or thereabouts has been this compression of margin. But as we come closer to the completion of these projects, which I think starting from the quarter 4 of this year, you will see the trailing effect of the legacy orders and the orders that we have recently won, recently in the sense last 6 to 12 months. Which have been bagged at better price points because of the current cost conditions, will start playing out in our profit and loss account. So the margin improvement will be progressive. It will not be sudden. And just as the margin slide was gentle, and we think we have sort of hit the floor and turned the corner. Quarter 1, we had reported in our infrastructure business particularly, 5.1% margin, and quarter 2, we are reporting 5.4. So the trajectory has taken a turn, and I think over the next 3-4 quarters, you will see us return to more normalized levels.
Okay, so if you could just elaborate a little bit more on that in terms of the E&C segment, hydrocarbons, infrastructure, when we can see margin recognition because of the extension of the legacy projects that did get delayed due to the pandemic, in terms of when that could potentially happen. That could be in the next 3 to 4 quarters, you're saying? And it'll be close to 60 to 70% for all of these order books, segmental?
That's what I'm mentioning. Actually, the bulk of the order book, if you take 451,000 crores, almost 3 lakh crore is on infrastructure, and another 1 lakh crore is on hydrocarbon. So if you look at the composition of the order book, over 80% of the order book is consisting of projects won in these two segments. So how these segments perform would drive the revenue and the profitability of the company going forward over the next 2 to 3 years. Because these projects, you must sort of appreciate, are a 3-year, 3.5-year execution cycle. So to that extent, I think the lingering effect of these projects on our revenues and profits will continue over the next 2 to 3 years. Having said that, the point that I was mentioning was, even as we speak today, hydrocarbon is in a much, much healthier position. It is reported for the half year ended 30th September 23, 9.5% margin. So I think we've gotten over the worries of the legacy jobs. Most of the legacy jobs that we speak about is in the area of infrastructure. And that is where the supply disruption was at its peak. And the price disruption was also very, very high. Now, those will trail out between Q3 of the current year, that is the quarter that we are currently working through, and in the next couple of quarters. So I would expect, starting from Q3, going on all the way till FY 24-25, the margin profile will keep getting better, unless, of course, we are going to have another black swan event like the one we had in 20.
Okay. Now, when it comes to the energy segment, we have seen pretty strong orders as well. That was nearly 4 times higher when compared to what you put out in the corresponding quarter of the previous year. What's the outlook on that segment, and even high-tech manufacturing segment on the flip side? That had been slow in the first half, but the confidence is there due to the defense orders.
You know, the manufacturing sector, which consists of our equipments that we manufacture for the hydrocarbon and nuclear sectors, as well as the defense, have been an important technical corner points of our company, but they never are at a scale which will move the needle for the company as a whole or group as a whole. But it is very important that they operate currently around $500-600 million level of activity, each one of them. And they've not broken past that level because the markets are like that. They are not as bulky as infrastructure order or hydrocarbon order per se is. And defense, as you know, is a lot of decisions that gets taken in the defense ministry and in Delhi as to how much of procurement will be done by local partners and at what frequency, at what pace, etc. The fact over the last 25-30 years that we have been partners to DRDO and other wings of the defense ministry is actually an advantage for us from a point of view of technical pre-qualification. But I think the commercial decision to procure from private sector outside of the nomination basis on which the public sector defense manufacturing units get their order is a call that the government has to take. I think there is a realization that we need to, at least for deterrence purpose, needs to improve the quality of our defense systems. Warfare has now changed. They are no more fought on the ground. They are getting more and more electronic. So the advancement in technology is very important. And the government is seized of the fact that India as a country has enormous talent on the technology front when it comes to electronics and digital. Now, when world is using our technical powers, it's very natural for India to use. So we're very hopeful that over the period of the next 1-2 years, we should be able to get defense off the ground in terms of the level of operations at which we are. As far as high-tech manufacturing, the other wing is concerned, which is hydrocarbon equipment. If the refineries, petrochemical plants invest, then we are in business. Our equipments are in demand. And our equipments are supplied to the global markets. So be it South America, be it North America, be it Australia, our equipments go. So it's a question of investment in the refining space. With the energy transition that is happening, maybe there will be some reset of the technology that will underpin these investments. And we do hope that our R&D efforts will keep pace with those changes.
Now, given the fact that a large portion of the order book comes from the Middle East, given the fact that there are those geopolitical concerns playing out there, how is that impacting business?
Fortunately, the bulk of the order book that we have is from Kingdom of Saudi Arabia. Among the GCC countries, Saudi Arabia is the strongest when it comes to the investment momentum because they are in the midst of implementing their Vision 2030. And we do believe that none of these strives that are in their neighborhood is actually distracting them as we see things today. Much of the projects that we are doing in the kingdom, and particularly for companies like Saudi Aramco, is on track. And we do believe that they are not likely to be disrupted by the recent conflict that Israel has got into. We hope that that the Saudi Arabian involvement in all of these conflicts will continue to be low as it is today. And given that political stance as well as the economic vision that they have for the country, we feel at the moment reasonably secure. Of course, we'll have to keep our ears to the ground and keep operating with all the intelligence that we can, but nothing to lose sleep as we see today.
Okay, that's good to know. What about the outlook when it comes to your foray into new businesses, electrolyzers, green energy? How are you looking at that really building and improving the ROE and helping the company perform well?
It's an important part of our strategic plan. We've spoken about this in the past that we have a 5-year strategic plan, which actually has invested time in trying to create alternate streams of revenue and profitability and growth for the company. We are reasonably confident we will do more of what we actually do already well. That's been given. Now, what is going to be the incremental avenues? And while deciding on that, we have taken a conscious bet towards flipping over the technical technology side of business. Because at the end of the day, regardless of the level of technology that we use, much of our revenues and profits come from building hard assets. So the pivot to technology-based businesses has been in our minds. And the fact that this energy transition and climate change and the consequences of that is pretty telling, and as all of us are experiencing today in various parts of the globe. So I think the time is now for us to actually start acting towards less carbon emission, reducing the footprint, and taking care of our planet. And for doing that, the world has to grow, because growth is energy. The world has to grow, then energy has to keep pace, and it cannot be the traditional, carbon emitting sources. So hydrogen is going to be an important element in this. The cost competitiveness needs to be established, because the budgets for energy transition is pretty startling. It's very large numbers. The governments have to decide as to who is going to foot the bill. Is it going to be the governments per se? Is it going to be the public? Is it going to be the industry? So when all this is getting decided, we have to, as industry, keep working on technology to make it more cost effective.
Okay, that's L&T still holding on to the gains after its stellar set of numbers, and clearly the management extremely confident of maintaining this kind of run rate, if not upping it.